And thank you everyone for joining. We are on the 20th of January. Emerging markets have made a steady start to 2026, following an extremely good 2025. I am just going to provide a brief introduction of Albury Capital Management itself, for those of you who are not familiar with us. We founded ourselves in 2006. It's still an employee majority-owned company. We have two main strategies. One is global, and one is global emerging markets, which is obviously what we are talking about today. We have about $1 billion under management, about 2/3 of which is in the emerging market strategy, which is via a public fund, plus several mandates which have been provided to us by a consultant in America. We are a very, very experienced team. I think possibly, arguably, we are perhaps even the most experienced emerging market investment team in Europe. In both strategies, global and global emerging market, we are benchmark agnostic growth stock investors. We believe in buying into quality growth stocks. Now, people talk loosely about quality growth stocks. Our definition of a quality growth stock is a company where we expect the earnings to grow at least 15% over the next 2 years, which is generating a return on equity in excess of 15% and is very cash generative, which you can then use to finance its growth going forward. We have been going, as Charlie was kind enough to say, since 2012. We have got an extremely good long-term track record in emerging markets with an annualized return of almost 9%, which compares very favorably with the 4.7% generated by the emerging market index itself. We tend to have a very, very strong upside-downside capture ratio because we focus primarily, but not exclusively, on domestic consumption. These tend to be less cyclical businesses, slightly more defensive in bad times, and generally speaking, they're the place in our long experience where we think people should focus their attention. So, what about 2026? The answer is that we are extremely positive on the outlook for the coming year. There's a combination really which is acting very powerfully in their favor, which is a weakening US dollar and a low oil price. Now, both these components are exceptionally important for emerging market economies, primarily, of course, because they very, very much focus or very, very much affect what happens in the inflation data, which is coming through into EM and developing markets. As an asset class, emerging markets have been very, very under-owned and very maligned for 10 years or more. As a long-term Asian experienced investment fund, I know that these things come and go regularly. They tend to be quite cyclical, these markets, but this has been a very, very long down cycle, and I think there are lots of very good reasons to suppose that this time round it's going to change. One of the areas that we are most interested in is India. We think it's an incredibly good opportunity, 1.4 billion people. Demographics are exceptionally favorable. It's got a very, very business-friendly, growth-orientated government. And in our experience and estimation, the management quality and the opportunities available to investors is absolutely exceptional. In the last year, in 2025, AI has been the real driver for emerging market indices. The Korean market, for example, in the last 12 months is up 94%, Taiwan up 36%. We have admittedly found it very, very hard to keep up with this because although we do technology investment, and we own Samsung Electronics, SK Hynix, TSMC, and one or two other counters who are AI and technology focused, we haven't been able to put enough money into battle on this sector, and it has meant that we've had a very tough year trying to keep up with a very strong EM index, which, by the way, rose 32% last year, against a 20% return in the MSCI World Index. However, that said, our portfolio looks extremely strong at the moment. We are expecting earnings per share growth of 26% in 2026, and for all that, you're paying 19 times earnings, so it's on a price earnings to growth ratio of 0.7. We have 33 companies in the portfolio at the moment, and only 10 of them have got any debt at all, and so they're generating a very, very high return on equity in excess of 20%. Without gearing their balance sheets. It's a very, very strong portfolio. Now, I spoke earlier about the US dollar. Well, this chart here, just for a little bit of explanation, we have inverted the dollar index. And so when the dollar, the green line, which is a dollar index, is rising, it means that the dollar is weakening. We've done that in order to sort of present a proper correlation with the EM index. And you can see that it works on a sort of 5 to 7 year cycle, the dollar generally. This is a long-term chart. And at the moment, the dollar is conspicuously weakening. Now, this is important because it means that emerging market central banks are able to loosen monetary policy and to drop interest rates, which is very, very beneficial effect on their economies. And you can see that there is a very strong correlation. As the dollar strengthens, emerging markets tend to underperform developed markets, and the counterpoint is reached at the moment where the dollar is weakening, and you can start to see emerging markets coming good, which is exactly what we want to happen. And our view is that this will continue. Now, one of the reasons it will continue is also because of the oil price. And here is a 5-year chart on oil. And from time to time, you get a rally because of the crisis in the Middle East or something, but the overall trend is very much downwards. And with the exception of the Gulf countries, with the exception of Malaysia and possibly Brazil to some extent as well, all emerging market countries, and certainly all the ones that we are most interested in, are very, very heavily dependent on oil imports. And this is unequivocally an extremely beneficial effect, the lower oil price. So where does this take inflation? And you can see here with these two lines, a little explanation again, if you don't mind. The black line is emerging markets economy inflation. The red line is a developed world. Now, historically and pretty much invariably, the black line is well in excess of the red. It's partly because these are faster growing economies, partly because they are less well resourced. The infrastructure is less good. There's perhaps an element of over-regulation, possibly even an element of corruption. But they are less efficient in terms of generating good returns from the economy, despite the fact that they're growing fast. And so you tend to have a higher inflation rate generally. Most of my career, the Indian inflation rate has been at about 10 or 11%. And at one of our subsequent charts, you'll see that it is dramatically lower now. But the point is about this chart here is that inflation in emerging markets is now falling over and dying, which is exceptionally good for interest rates. And that is very good for stock markets. And indeed, here is what the central banks are doing currently. This is 15 different central banks. Little busy chart here, but I mean, the blue lines means that rates are rising. The yellow line means that rates are falling. And you can see that in the last few quarters, no central banks in emerging markets have been lifting their interest rates because they haven't needed to, because inflation is very, very benevolent and getting better all the time. And this is something that we very much like as equity investors in EM. And indeed, I spoke a second ago about India. I've been looking at the Indian markets since the early 1990s, and habitually the inflation rate averages between 8 and 12%, I would say. But this is a 5-year chart or 4 or 5 year chart, but it's basically, you can see very clearly that the Indian CPI, the red line, is falling very dramatically. And yet still the GDP growth for India is absolutely exceptional. The second quarter last year, the GDP rate was, they work on a March year end, so the second quarter is the recent quarter for India. The GDP growth rate was in excess of 8%. And meanwhile, the inflation rate is continuing to fall. Soft commodity prices have been good. As said, the oil price is very, very important. And the interest rates in India at the moment are still at about 5.2%. And therefore, the real rate of borrowing is still pretty high. But in our view, Indian interest rates are set to move lower in the next 12 months. And one thing that has really affected our performance in the last year, and as I mentioned earlier, the Indian market is an area we're really keen on. But it's not an AI play, I'm afraid. As I mentioned, Korea and Taiwan have been the ones that have really benefited, and India has probably been a source of cash for people to refuel into Korea and Taiwan. And the underperformance of India against emerging markets is at really record levels and at reversal levels as well. By the way, I should say that India actually is the best performing, or has been the best performing stock market in the last 20 years, even better than America. And so, you know, the opportunity to make a lot of money in India remains extremely good. And in our view, is actually still very, very much one of our preferred markets. But it is tough at the moment because of what's going on in AI. And indeed, this is really what I'm talking about. You can see from this chart here that this is a database identified by UBS, which basically sort of says what percentage of stocks in the different markets are beneficiaries of AI. Are they providing bits of computers? Are they providing some software? Are they providing anything that goes into the AI spend, which, as we all know, is at record and unprecedented levels? And you can see that in Taiwan's case, 80% of their market is AI beneficiary stocks. It's partly because TSMC, of course, is so enormous. But it does mean that if for the AI market or to really benefit from AI investment in emerging markets, there are really only two markets that have really mattered, and that is Korea and Taiwan. As I say, Taiwan was up 36% last year, and Korea up 94%. And a lot of the Korean stocks were up a multiple of that. And the flip side of that, also, as you can see at the towards the right-hand end of this chart, India is pretty much negligible. Now, if the AI so-called bubble, we don't think it is a bubble, but if it deflates somewhat, then in our view, India is going to be the prime beneficiary of the weight of money that will move back to other emerging markets out of AI. And one of the areas which actually is still potentially quite exciting on the AI front is China. Those of you who take a keen interest in emerging markets and this sort of thing will remember that about this time last year, a Chinese company called DeepSeek revealed its own AI technology and capability, and it had an extremely good effect on the Chinese stock market for the rest of the year, give or take, but very much focused on technology. One of the reasons why China is able to benefit very well from AI, should it come to pass, or should they continue to develop it, is that unlike almost every other country in the world, they have an enormous capacity for electricity generation, which obviously is very, very important if you are putting together data centers and using AI. So this will be a trend that, in our view, in China will continue. They will continue to be a strong beneficiary of the AI trade. What has not worked so well for China, and indeed has affected our ability to make money in China, has been, as I said, we focus to a very large extent on consumer. And we don't just mean eating and drinking and washing and wearing. We mean anything from first bank accounts to property to motorcycles, motor cars, whatever it might be. And if I was to take this chart back another couple of years, I'm afraid you would see that it had fallen off a cliff. The Chinese property market has been in disarray for a number of years now, and most people in China, their property is probably the thick end of 70% of their family wealth. And so if your property is declining at about 15% a year, you're not feeling very positive about life. But they've been feeling pretty negative about life for quite some while now, and there is some signs that things are stabilizing and that things are at the margin going to get a bit better. So again, I think that there's grounds for some cautious optimism that the Chinese consumer will start to come to life again in 2026. And finally, almost our final chart, is the evaluations. And I spoke about our own portfolio. This is the emerging market index itself relative to the US. And you can see this is a very long-term chart, a 20-year chart. And you can see that the valuations, which peaked in sort of the financial crisis time, 2007-8, and a bit thereafter, have been on a constant decline ever since then, and are now well below their long-term average. Again, this is a very, very strong inducement, I think, for people to take another look at emerging markets and consider it as a very good proposition. So what I'm going to just summarize on, if I may, is that we have got a very strong long-term track record of outperformance. We are active stock pickers. There's no question about that. We do focus on the consumer, and I'm very happy that we do, because what I can't tell you is what the price of semiconductors will be in 12 months' time. I can't even tell you what the price of oil will be in 12 months' time, but I can tell you that more Indians will be riding motorcycles, driving cars, or owning their own property. And these are very, very consistent trends. As people work hard, save hard, get rich in emerging markets, the consumer focus, I think, is a very, very strong underlying tailwind for our portfolio. We, as investor managers, have a very strong commitment ourselves to the fund. I have a very decent chunk of my net asset value in this emerging market portfolio. We are, as I mentioned, a very experienced, very stable investment team. And we've all been together for over 10 years. The investor managers and our analysts have been with us for at least 8 or 9 years on average, I would say, probably. We do, as I say, have a very strong bias to growth. We are very interested in market leaders. All of our portfolio companies will either be the leader or very close to being the leader in whatever sector or specialization that they are conducting. And it's a very high conviction portfolio with a very, very strong active share constituent. Traditionally, our active share component is about 85%. It's a little bit lower at the moment because of our holdings in these big Korean and Taiwanese tech companies, but by and large, it's a very active and I think interesting portfolio. And just as our final chart here just shows you what we have done since 2012 when we started the strategy, and I would commend it to you. 224% against 135% is a decent margin, albeit we've had a tough time in 2025 keeping up relatively. The portfolio was still up 12% in 2025, but obviously that is not good enough if you compare it with an index of 32%. But I think that the outlook for 2026 is very positive, and we're looking forward to really starting to move the needle again in the coming year. So thank you very much for your attention, and I hope that makes reasonable sense. And if not, please revert to LGBR or ourselves directly if you'd like with any questions. Thank you.